Hi guys, welcome back to my channel. Kelvin here. One of the most talked about subjects in investing is passive income, aka printing free money. As it turns out, there's an ETF that gives you huge passive income called QYLD. If you check the ETF, it has a godlike 12% distribution yield. So is this ETF much better than all the other Singapore dividend stocks which only pay a lame 4% dividend? Maybe. And that's what I'm going to talk about today. In this video, I will explain QYLD and how it can give you such high yields, how its past performance. Finally, I will tell you what I think about QYLD and whether you should invest in it or not. But before I start, I would greatly appreciate it if you can help to tap the like button because it will help out with the channel. In return, I will show you two cute cats. Alright, let's start right now. Okay, let's first talk about what's QYLD. Basically, think of it like this. I got a Nasdaq 100 index, I got a covered call, I got a QYLD. Now, people who have experience in investing will know what I'm talking about. But for everyone else, they'll be like, huh? What talking you? Okay, let's go through it one by one. I'm sure most of you have heard of S&P 500, right? It has the top 500 companies in the US. Meanwhile, there's another index and that is Nasdaq. Think of S&P 500 like Milo and Nasdaq like Rico. They are same but different. While the S&P 500 has the top 500 companies in the US, Nasdaq only has 100 companies in it. If you look at Nasdaq holdings, it is super duper heavy in technology at 52%, followed by consumer services, healthcare, financials and others. And because these few sectors tend to perform better than other sectors, Nasdaq will outperform S&P 500 over the long term. Okay, so that's Nasdaq. Now, let's talk about the second part of QYLD, which is covered call. You can think of covered call as a bet that the stock won't go above a certain price. And for making this bet, you will get paid some money, or a more fancy word is premium. If the stock stays below a certain price, nothing will happen, and you basically collected the money for free. But if the stock goes above that price, you have to sell 100 of your stocks to the other guy at a fixed price. Let me show you a quick example. This is the fruit company, Apple. The stock is now about $180. I can do a covered call at $190, and by doing this, I will get paid $250 premium immediately. Then on January 28, if Apple stays below $190, nothing will happen. But if Apple goes to $200, I will have to sell 100 stocks at $190. So that's covered call. Okay, yeah, that's basically what QYLD is doing. They buy the stocks in the Nasdaq index, then sell call options on those stocks. And by selling, they collect premiums. So that's how it can pay a godlike 12% dividend. Okay, let's go a bit deeper into QYLD. First, the total expense ratio is 0.6%, which is slightly higher than normal ETFs like VOO, which only has like 0.03% expense ratio. This means that when you invest in QYLD, for every $1,000 you invest, 0.6% or $6 is used to pay the fund manager so that he can buy his Chai fund. Second, the dividends are paid every single month, and they proudly announced that they have managed to pay dividends without fail for 7 years. Third, for the covered call option, they are selling calls that expire every month, and the strike price is the closest listed strike price above the last value. So back to the Apple example, if Apple is $179, they will be selling a call at $180 strike price. What this means is that they will get a very high premium. However, this comes with a problem. Selling a covered call limits your upside. And because Nasdaq has those stocks that always go to the moon, QYLD growth is limited. We can see that since QYLD came out, Nasdaq has gave high return while QYLD looks like a flat line. But remember, QYLD has a 12% distribution yield. So if you add in dividends, since inception, QYLD has given about 9% annualized returns, which is actually not too bad. Considering that the ETF that's tracking Nasdaq or QQQ gave like 22% annualized 10-year returns. Then you'll be like, QQQ like better, why not just invest in QQQ? Can, no problem. But QQQ only pays like 0.49% dividend, which is very little. So you need to be sure what you want here. You want high growth? Then you go for QQQ lor. But if you want high dividend, then you can consider QYLD lor. Next, let's talk about when will it make sense to invest in QYLD. There are 3 scenarios. First, bull market, like I mentioned earlier, selling a covered call will limit your upside potential. If you take a look at this chart, the blue line is QYLD and orange line QQQ. It compares the money returns between the two ETFs. If you look at any month which had positive returns, QQQ or the orange line will always be higher than QYLD, the blue line. This means that in a bull market, QYLD will definitely underperform the QQQ. Second scenario, bear market. So covered call only limits the upside, but it doesn't limit the downside. So QYLD will fall together with QQQ. However, because QYLD sells covered call to collect extra premium, the downside will usually be slightly lower compared to QQQ. Back to this chart. If you look at whenever there's negative returns, QYLD drop a bit lesser compared to QQQ. But why on February 2020, QYLD dropped more than QQQ? Is it a bug? According to the author, it has something to do with how he recorded the data. So that's why it looks like QYLD dropped a bit more compared to QQQ. But in actual fact, QYLD still dropped lesser compared to QQQ during that period. If you look at this chart, you will see this clearly. In 2020, QQQ went up more than QYLD, but during the February-March crash, both dropped by almost the same percentage. After that, we all know what happened. The stock continued to chong up and everyone be like, "Anya, I wish I bought the dip." But even though QYLD drops lesser than QQQ in a bear market, it's actually not good for QYLD because the covered call is capping its upside. It will take a very long time to slowly climb back up to where it once was. For example, after the March 2020 crash, QQQ reached back to its previous level after just 3 months. But till now, QYLD have not actually went back to the previous price. So a bear market or a big crash is actually bad for QYLD. Finally, third scenario, flat market. In a flat market, the stock just go up and down, right? It doesn't go anywhere. Meanwhile, QYLD keeps selling covered call to collect premiums. So in a flat market, QYLD will usually outperform QQQ. Those were the 3 scenarios. In short, QYLD will give higher returns when the market is flat or when the market is going down. But obviously, we won't be able to time this perfectly, right? So it just boils down to 2 situations again. You want high growth? Then invest in QQQ lor. You want high dividends? Then invest in QYLD lor. Okay, now comes an important question. Should you invest in QYLD since it gives like 9% annualized returns? Well, yes, but no. Here's the thing, QYLD is an US ETF and US has something called withholding tax, where Uncle Sam be like, "I want 30% of your dividends." So instead of the 12% dividends that we will receive, they will take away 30%, leaving us with only 8.4% dividends, which makes us sad. That's like if you order Cai Fan, the auntie only gives you 70% of the meat, veggie and rice. And that's not good, huh? So I'm estimating that instead of the usual 9% annualized returns, after the 30% withholding tax, you can probably expect around 6 to 7% annualized returns. But 6 to 7% is still quite high. Maybe it will outperform Singapore ETFs leh? Let's try to compare a bit. The first one is our favorite STI ETF, which basically went nowhere since 2009, the year when I was still watching Pokemon on TV. But anyway, STI ETF gave about 4% 10-year annualized returns. So this means that QYLD performed better than the STI ETF. The second one is IHS REIT Index, which tracks all the Singapore REITs. This index gave about 9% 5 years annualized returns, which actually beats QYLD. This tells me that if we just focus on Singapore dividend stocks like the banks, telcos, REITs, it will actually outperform QYLD. This is expected because while QYLD has covered call which limits the upside, for normal stocks there's no covered call. So they can chong to the moon all day long. And this is important because over the long term, stocks tend to go up because stonks. No lah, not because stonks. Because that's how our world works. Companies come up with new stuff, people earn more money, people can buy more stuff, which will increase the company's profit, which will drive stock price higher. That's why the S&P 500 can give like 10% annualized returns over the long term. So how is QYLD a bad ETF? Based on history, where the market have went up overall, it does show that QYLD is a bad ETF. So I have a few alternatives. First, there's another ETF by the same fund manager called QYLG. Instead of doing cover cost on the entire portfolio, QYLG only does it on 50% of the portfolio. So this will give you more upside, but it will give you lower distribution yield. The yield is 5.5%, about half of QYLD. And if you look at the charts, QQQ gave the highest performance, followed by QYLG, then QYLD is the worst. The reason you will invest in QYLG is similar to the reason you will invest in QYLD. You want passive income and you feel that the market can go sideways or go down. Also, QYLG has an additional benefit compared to QYLD because the yield is just half of QYLD. This means that you are taxed lesser on your dividends. So that's the first option. The second option is actually quite straightforward. You just invest in Singapore dividend ETFs lor. The Singapore dividend ETFs like the Lion Philippe S-REIT ETF, Philippe Sing Income ETF, Nikko M ETF are all very stable POMPP stuff. You basically won't go wrong with them. But there's a third option. You buy QQQ, then you sell options on it yourself. It will give you more control. For example, if you think that QQQ is going to go up next month for whatever reason, you can either sell a very far out of the money option or just stop selling option for that month. That way, you won't limit the upside potential of QQQ. And even if you sell a call option and QQQ went past your strike price, you can always roll your option to avoid your QQQ getting called away. And best of all, the premiums that you receive from selling options is not taxable. So if you get $100, you'll receive all that $100. Nice. But the downside is, it is super expensive to sell option on QQQ because you need like 40k to own 100 of QQQ. So yeah, here are my final thoughts. I wouldn't consider investing in QYLD because there are tons of better dividend paying investments that give better returns. Stuff like Singapore dividend stocks or just selling options myself. But what do you think? Are you investing in QYLD? Do you think QYLD is a good investment? Let me know down in the comments below. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.